balance sheets provide a snapshot of a company's viability. One sheet contains a company's assets and the other sheet contains its liabilities. Technically, the liability sheet is called liabilities and stockholders' equity, as it includes funds invested by external investors that are considered owners. We will start with the asset sheet. Here we see the asset and liabilities. The assets and liabilities are divided into current assets and long-term assets. Current assets mean they are what can be changed to cash within 1 year or less. If it's longer than that, it's a long-term assets like equipment, buildings, lands, which could be sold in a year, but they just consider that at the time you get around to doing it, it probably is more than a year. We start with cash, and that comes right out of the ending balance of the cash flow statement that we had in the previous video, 2,288. That's an asset. Then we have some working capital accounts, which are assets, inventory, materials, finished, receivable. Technically, they could be sold for cash, or they could be collected from our customers. And they come right out of the working capital worksheet, the 1,008, 3,330, and 5,968, which are these three values here. So that totals up to be our current assets. We have long-term assets, 11,050. These are just from your book somewhere. You have a counting of these. And they total up to be 18,950. There could be others. So we get total assets of these, the sum of these, which is $39,544. Now we'll go to the liability side. The current liabilities, in this case, will be strictly the liability accounts from working capital. The 930, 45, and 60 are recorded down here as positive values. The whole sheet is liabilities. You total those 1,035. We have some long-term liabilities, long-term loans, 1,500, and some bonds, which is 6,100. If you had short-term loans, they would be in current liabilities, loans that have to be paid in the current year. In this case, we do not have that. And note, stocks are not part of these. Stocks are stockholders' equity, which comes down here. We have 26,800 invested by investors in the company, and we retained earnings from our income statement amount. They accumulate here. Any net incomes are added to this each time period, and that totals will be $30,909. You add those three up and you get $39,544. Note that these two are equal. They're both the $39,544. They must be. If everything is done right, they will come out to be the same. That's a very important check to make every time you do this. One other thing that comes somewhat out of this is you look at this. You have to know the shares outstanding. If you know that the stock that you have here, it comes in from 1,000 shares, and if you go to the Wall Street Journal or Yahoo or whatever and get the stock price on a certain day, say it's $44.50, the market capitalization, as they call it, of the company is $44,500. That is higher than this because the stock price changes every day. This stock value stays the same when the stock was purchased, the money that was invested in the company. This is what it was. That is not what it could possibly sell for today, because stock prices go up. For instance, Apple has a quite high stock price compared to what originally was paid for stock. And although not the largest company in sales, they have the largest market cap of most any company today. They're very profitable. And that includes the description of the two balance sheets, the assets and the liabilities.